Not long ago, I had my aunt and niece come visit me for dinner. Except, all I could think about was the bandage on her head. So I asked her, "How did this happen?"
I saw it on the news. My bank just collapsed, Achu. I panicked. I ran to the bank. I was going to just withdraw everything and move it someplace safe. But I guess I was not the only one with that idea, because when I got there was a massive crowd making all sorts of demands, and they had no money to give. The bank just didn't have the money. And like that, in an instant, Neetu's college fund gone. It was complete chaos. There was this old man standing next to me, and he kept shouting, my pension, again and again. People were screaming, yelling at the top of their lungs. And suddenly, everything just shattered. I decided I was going to get out of there. But before I knew it, someone crashed into me, and this is what happened.
Hearing all this made me dig deep into the matter. I had to understand, why couldn't the bank return people's money? What exactly is money, and how do banks create it out of thin air? If you want to level up your finances and get better at playing the game of wealth, you need to wrap your head around this absolutely mind-boggling detail. 95% of money in existence, including what's in your bank account, isn't actually real. It only exists because we agree that it does. To understand why your money doesn't exist, we need to go back in time to understand why money was invented in the first place. Imagine you're a farmer 5,000 years ago. You grow wheat. Your neighbor raises goats. Should be simple to trade, right? Some wheat for some milk. But your neighbor doesn't want wheat. He wants pottery. The potter wants metal tools. The blacksmith wants leather. The leather worker wants wheat. But not your wheat. He wants the higher quality wheat from the farmer across the river. This is what economists call the double coincidence of wants. Both parties need to want what the other has at the exact same time in exactly the right quantities. It's an impossible puzzle that our ancestors faced every single day. And even when trades aligned, how did you value things? Is one goat worth 20 pounds of wheat? 50? What if it's a young goat versus an old one? What about seasonal variations? Plus, wealth was impossible to store. You couldn't save wheat for decades. It would rot. You couldn't accumulate goats indefinitely. They'd die. There was no way to build long-term wealth or security. So humans did what we always do. We innovated and created a middleman, money. You know, the early forms of money were so fascinating. The Aztecs used cacao beans, literally chocolate, as currency. Pacific Islanders used massive stone discs called rice stones, some so large they couldn't be moved, so ownership was simply declared and remembered by the community. Coastal regions used cowrie shells. Ancient China used knife and spade-shaped metal pieces. But all of these had a fatal flaw. Anyone could create more. Pick shells from the beach, grow more cacao, carve more stones. There was no control over supply. So, breakthrough finally came with government-based currency. First metal coins in ancient Lydia around 600 BCE, then paper money in China during the Tang dynasty. These could be standardized, controlled, and crucially backed by something valuable. So for centuries, this backing was gold. The gold standard meant every rupee, dollar, or pound in circulation could theoretically be exchanged for a fixed amount of gold. It basically limited how much money governments could create. No gold, no new money. It was simple. And this system was what built the modern world. It enabled trade between strangers, allowed wealth accumulation across generations, and created the foundation for every economic innovation we enjoy today. But then, we abandoned it, and that's where our story really begins. In 1971, US President Richard Nixon made an announcement that changed everything.
I have directed Secretary Connally to suspend temporarily the convertibility of the dollar into gold or other reserve assets.
And with that single decision, money became fiat currency, backed by nothing except government decree and collective faith. Every major economy followed suit. Suddenly, money wasn't tied to anything physical, it was just trust, paper, and promises. But even this paper money, the notes in your wallet, represents only about 5% of all money in existence today. The other 95%, it's a shared hallucination of sorts. It exists only because we believe it exists. Let me show you what I mean with real numbers. So around 1960, India's GDP was $37 billion. Today, it's over $4.2 trillion. That's 4 trillion in new money that had to come from somewhere. We didn't discover 4 trillion worth of gold. We didn't print 4 trillion in notes. That would cause a hyperinflation like Zimbabwe, where they literally had $100 trillion notes that couldn't buy a loaf of bread. So question is, where did all this money come from? Banks created. Not the government, not the Reserve Bank, but regular commercial banks. Your neighborhood HDFC, ICICI, SBI, they literally create money out of nothing. And it's completely legal. Now this is very interesting because here's how I thought banks always worked and how most laymen think that banks work. You deposit money, they keep it safe, maybe lend some of it out carefully and pay you interest for the privilege, like a giant locker with an investment fund attached. But I was completely wrong. So Richard Werner, a German economist, was the first to empirically prove what actually happens. When you deposit 1 lakh in a bank, they don't put it in a vault. By law, they only need to keep about 10%. That's just 10,000 rupees as reserves. The other 90,000, they can lend it out. But they don't lend out your 90,000, they create new 90,000. Let me repeat that because it takes some time to fathom. Let's say you deposited a lakh in the bank. The next day, someone walks into the bank with the hopes of starting a cafe. They borrow 90,000 from the bank and are credited with the same. Suddenly, new money exists that didn't before. The cafe owner now uses it to pay a carpenter for furniture, a supplier for coffee beans, and an employee for their first month's salary. Each of these people deposits their salaries into their banks. This system keeps repeating. Every time money is deposited, a portion of it is held in reserve and the rest becomes the basis for a new loan and therefore new money. So in theory actually, that single 90,000 loan could eventually lead to 9 lakh in total money circulating in the economy and all from one initial deposit. This system of fractional reserve banking is the backbone of every modern economy, and it only works because we live in a world of fiat money where money is created through trust. Trust in the system, trust in the legal frameworks that enforce it, and the belief that when you open your banking app and see a number on the screen, that number actually means something. Clearly, money at its core is this collective hallucination or a shared fiction, one that we believe to be a fact. This is how 95% of all money came into existence, not from governments or printing presses, but from banks making loans. Now you might be thinking, if banks can just create money, why don't they create infinite amounts? Why isn't everybody rich? Why does this system not immediately collapse? Well, the answer reveals something very profound about money itself. Banks can only create money when someone borrows it, and they'll only lend it if they believe you can pay it back with interest. It's like having a money printer that only works when someone promises to bring back more money later. Here's a crucial distinction Richard Werner discovered. Not all money creation is equal, and you need to understand this for all your future financial decisions. But before I break that down for you, I want to share another insight with you. You see, banks are fascinating institutions. They help create opportunities and influence economic growth like we just saw. So imagine you want to start saving for a terribly rainy day or build an emergency fund. You walk into a traditional bank looking for a savings account that helps your money grow. The bank offers you an interest rate, but it's low, maybe around 2.5 or 3%. Given the current inflation rates, you are actually losing money here. And worse, a lot of these banks have minimum balance requirements, maintenance fees, and the interest is only credited annually, which means you're not really seeing your money grow day by day. When banks borrow money from RBI, they do it at repo rate, which is at 5.5% currently. However, when they use your money, you only get 2 to 3% interest, and the rest of the gap becomes their profit. This is where Slice comes in. You see, banks should amplify, not erode your savings. That's the gap Slice set out to fix. Their savings account mirrors 100% of the RBI repo rate, currently 5.5% from the very first rupee, and they credit interest daily, so compounding starts instantly instead of once a year. For example, if you have 5 lakh in your account, that will make you around 31,000 in a year. That's nearly 2.5x what you'd get in most savings accounts from other banks. No minimum balance traps, no maintenance fees, no hidden clauses. Whether you have 5 rupees or 5 lakh, the rate is the same and the meter never stops. Need certainty for idle cash? Slice's fixed deposit pays 8.5% for 18 months, among the highest non-senior rates on the market. Opening up is as friction-free as sending a UPI payment. You download the app, set up your account in 2 clicks and immediately have access to the most seamless banking experience. Everything from UPI transactions to booking FDs all happens paper-free on one app. Plus, you get assured cashback on every UPI transaction. It's built to work the way most people already manage money today: digital, clean, and simple. The real innovation is actually transparency. Slice shows line by line how your money earns, turning the opaque black box of traditional banking into a glass box you can audit anytime. In a world where 95% of money exists only because we collectively agree it does, that clarity is priceless. It lets you keep your emergency fund growing in real terms while you focus on bigger financial moves. Now let's go back to the cafe owner's example, okay? After taking the loan, he runs a successful business. In doing so, customers transfer their money that they earn somewhere else in the economy into his wallet. The owner uses that to repay the loan. So in monetary terms, money has simply moved from the wallets of customers to the bank's books, from one part of the system to another. That's redistribution, right? Except something important happened in the process. While the quote-unquote non-existent money was moved around, people were fed, workers got paid, goods were produced, services were delivered, and even taxes were paid. That is economic velocity, and it gets counted as part of country's GDP. You see, from our perspective, money is a tool to measure value, to store wealth, and to exchange resources fairly. But from the perspective of banks and policymakers, money is productivity, or to be specific, a tool to generate productivity. Earlier, we talked about Professor Richard Werner, the German economist who changed the way we perceived banks. He went on to develop what's called the
quantity theory of disaggregated credit,
in which he makes a simple but powerful distinction. There's productive credit and then there's unproductive credit. See, when banks create money for productive purposes, that's building factories, starting businesses, developing technology, that new money leads to new goods and services, the economy grows, everyone benefits. But when banks create money for unproductive purposes, that's speculation, buying existing assets, consumer spending on depreciating items, you get inflation without growth. Prices rise, but wealth does not. Think about it this way, okay? Person A borrows 50 lakh to start a software company. They hire people, create products, generate exports, pay taxes. The new money created leads to new value. Now, person B, on the other hand, borrows the same 50 lakh to buy an expensive car that loses 20% value the moment they drive it off the lot. Now, that's the same amount of money borrowed, but no new value added to the economy. Both increased the money supply by 50 lakh, but only one increased actual wealth. This distinction between productive and unproductive credit is existential, because when too much credit goes towards unproductive uses, you get bubbles, and like we know, bubbles always burst. Now let me explain something about these bubbles to you. See, to understand what happened to that aunt's bank, we need to understand what happened in 2008, because it's the same story, just on a different scale. It started in the 1980s when an investment banker pioneered something called the mortgage-backed securities. The idea was very simple: take thousands of home loans, bundle them together, and sell shares in that bundle to investors. Now, the logic seemed bulletproof. Not everyone defaults on their mortgage at once. So by diversifying across thousands of loans, you create a safe investment. Now, these bundles, they received AAA ratings, the same safety rating as government bonds. And for 2 decades, it worked perfectly. But then something shifted. What started happening was banks started realizing that they could make money in 2 ways: creating loans and the interest on them, and immediately selling those loans to investment banks who would bundle them. Now, this meant banks no longer cared if borrowers could actually repay. That was someone else's problem. So lending standards collapsed. They basically created ninja loans. No income, no job, no assets. Yes, that's real. banks were giving huge loans to people with no ability to repay, then immediately selling those loans to be bundled into safe investments. Now, why would anybody buy these toxic bundles? Because the rating agencies, that's your Standard & Poor's, Moody's, Fitch, kept rating them AAA. These agencies were paid by the same banks selling the securities. The conflict of interest was obvious, but everyone was making too much money to care. House prices kept rising, so even bad loans seemed safe. If someone defaulted, the bank could seize the house and sell it for profit. It was a machine that printed money until house prices fell. We all know the story from here. Suddenly, millions of loans went bad simultaneously. Those AAA rated securities became worthless. Banks that had bought them faced massive losses. Lehman Brothers, a 158-year-old institution, collapsed in a single weekend. This was further amplified by a collective unrealistic optimism and a widespread, almost blind belief in efficient markets that blinded many to the emerging bubble. But here's what made it a global catastrophe. See, banks don't exist in isolation. They also lend to each other, invest in each other, depend on each other for daily operations. It's an interconnected web of trust. So when Lehman fell, banks that had lent to Lehman also lost money. Banks that were expecting payments from those banks panicked. Credits market froze. Banks stopped trusting each other, stopped lending to each other. And remember what I said earlier? All new money comes from lending. The money creation machine ground to a halt. Businesses couldn't get loans to make payroll, projects were abandoned, jobs vanished, the shockwaves reached everywhere, even to Indian banks that had no direct exposure to American mortgages. Because in our interconnected world, no bank fails alone. This also brings me to my aunt's local bank. You see, her small cooperative bank hadn't invested in American mortgages. They'd done something much simpler and more common. They had lent too much to local real estate developers. And when the real estate market slowed, those developers couldn't repay their loans. The bank had created crores in new money by making these loans, but that money wasn't coming back. Word spread, depositors got nervous, and then came the death spiral every bank fears, a bank run. The 2023 Silicon Valley bank crisis also, in fact, was a classic information run where news of asset losses triggered a rapid, digitally fueled withdrawal of unprotected deposits, demonstrating how quickly trust can evaporate and spread. Remember, banks only keep 10% in reserves. They can handle normal withdrawals, some people taking out money while others deposit, but when everyone wants their money at once because of some crisis, that's when there's trouble. The math is brutal. Even if 11% of depositors demand their money simultaneously, the bank cannot comply. Not because they're badly managed, because that's just how the system works. So after understanding all of this, how money is created and destroyed, here are 3 things all of you must remember. First is, your money is always someone else's debt. Every rupee in your account exists because someone, somewhere owes it. Your savings are actually someone else's loan. If they can't repay, your money simply ceases to exist. Second, the system is inherently very fragile. It's not designed to be stable. It's designed to expand, to create more money, more credit, more growth. But expansion always leads to excess. Excess always leads to bubbles. And bubbles, like I said, always burst. Thirdly and lastly, that same mechanism that has destroyed many people's savings has also funded many startups, many home purchases, and many business expansion. This is the beautiful, terrifying paradox of our modern financial system. We live in a system of extraordinary power and extraordinary danger. The question is, how do we protect ourselves while still participating in the growth it enables? I think the very fundamental starting point is knowledge arbitrage. See, most people don't even understand how money works. This creates opportunity. The more you understand the system, the better you can navigate it. For example, remember Werner's distinction that we spoke of, productive and unproductive debt? Use that knowledge. Debt that generates income or appreciates in value can actually make you wealthy. But debt for consumption or depreciating assets makes bank wealthy at your expense. For example, a home loan for a property you rent out, productive. The rent pays the EMI and you keep the asset. But an iPhone on EMI, that's unproductive. See, understanding these nuances about our financial system and how productive debt can be an insane tool can actually help you punch above your weight. Understanding of debt along with risk has honestly really helped me build the ecosystem we have here. So another thing that I wanted to share, something that a lot of individuals inherently never think about, is their relationship with money. How to save, how to spend, how to invest. Actually, a lot of Gen Z I see today don't even know why they spend the money, what they spend on, why they're buying the things they want. I read this quote recently that really stuck by me. It basically says, savings equals income minus ego. One of the most powerful ways to increase your savings isn't just by raising your income, but by raising your humility and avoiding spending money to show that you have money, which is where a lot of the younger generation ends up spending money buying things to curb their mimetic desires or indulging in status signaling. Honestly, there's a lot more to this, but that's for another video. Lastly, you need to make sure whichever bank you're storing your money, A, it's safe, and B, your bank should also be increasing the value of your savings and money over time. The Slice Savings account is designed for anyone seeking simple and transparent banking with a lot of perks and no terms and conditions. So click on the link in the description to check them out. Honestly, if there's one thing that you want to take away from today's video is, above all, you must educate yourself. Understand the forces that shape your finances. The question is not whether the system is perfect, because it's not. The question is whether you understand it well enough to navigate it successfully. The illusion of money is real, the dangers are real, but so are the opportunities for those who see clearly. In a world built on collective fiction, understanding reality is the ultimate advantage. That is all for today's video. Thank you for watching. Don't forget to hit the subscribe button. See you in the next one. I've got some big news to share. So Aevy is expanding and we are on the lookout for senior motion graphic designers who have at least 2 years of experience to join our team. So if you're somebody who's obsessed with pushing the boundaries of video and want to work with some of the best editors, filmmakers, cinematographers, and like experimenting with Gen AI, filmmaking, storytelling, this is your place. Our goal is to create the best videos the internet has ever seen. And if you want to be part of a team that's redefining video, apply now or share this with somebody who should.